Welcome back. Hugh Giddy is Senior Portfolio Manager and Head of Research at Investors Mutual. And he recently penned a newsletter for IML investors called Sustained Sluggishness, which outlines how he wants to play stocks going forward. I caught up with Hugh earlier this evening and started off by asking him about the approach his newsletter takes.
It's a relatively pessimistic outlook on where the world is and where the world's going. But we think that should frame people's investment decisions. It certainly frames ours, in terms of what we expect from our companies and our investments. It's because I think over time, since the GFC, a lot of people have had high expectations of a recovery because they're looking at past recoveries rather than what's likely to transpire and what has transpired since the GFC amongst most global economies. Even China has slowed down.
But if you look at, say, April, May last year, the ASX 200 index nearly hit 6,000, and then there was a revision on how good, I guess people thought the world economy was, how strong the US economy was, and all the other factors that might affect, and commodity prices clearly. And then, okay, so we fell, but at the moment we're making a comeback. Are you saying to me that this comeback of the stock market is not trustworthy?
I'm not referring, it's a more of a long-term piece than a short-term thing. I mean, this comeback is a improved sentiment largely towards resources and banks that was sold off in the earlier part of the year. Commodity prices have risen. Whether that's durable, I'm not sure. Banks have risen again, having fallen on worries about the housing market. There was some press about the credit standards in lending. And everyone knows our housing market is one of the less affordable ones worldwide, and so that's always a tail risk for the banks because they're very exposed to the housing market. And we've just seen improved sentiment, a little bit of short covering, some investment. But the piece is really focused on long-term things. Things like the aging demographic, which is not saying that it's going to change month to month, but is really set in place for many years to come, that people are getting older, and as people get older, they spend less, they borrow less, and they're less likely to drive economic growth.
Okay, now Hugh, this is where I've got you. I respect your analysis, and a part of your analysis is to say that, well, people are looking at, the old views on recoveries and things like that. You may well be looking at old people of the past and thinking that old people of the future will be the same, because the old people I knew of the past didn't go overseas, they didn't buy new cars, they didn't live to 85 or 87 on average. Could you be stuck in an old world analysis?
That's an interesting point. You're absolutely right. What's available to older people is different, but I think younger people also didn't travel overseas as much as they do now. So it's still a shift from people who are earning significant amounts of income, or relatively significant amount of income, and have large spending obligations in front of them, like school fees, buying and renovating homes, that sort of thing. As you're older, your spending obligations fall away because you've got fewer dependents. And also often you don't want to fix up your home, you don't want to shop for new fashion. Some older people do, obviously, but you're not as concerned about those things. You don't have to stay with the latest technologies and so forth. In my experience of older people, although I'm not an expert on aging. We might be looking at old people taking cruises and so forth, but a lot of old people are on the age pension, which is certainly not going to fund a great deal of spending.
Okay, that's a point worth considering. What other negatives out there? Because as you say, this is not Hugh Giddy at his optimistic best. this is the more pessimistic view. What else out there worries you? And I guess that worry is sort of saying, don't expect a nice, happy, booming stock market. Is that a fair link conclusion?
It's a fair conclusion. I suppose what I highlight in the piece that I wrote is we've got sort of three main things that I think are headwinds to growth, and what's a headwind to growth is a headwind to corporate sales and corporate profits. And on a selective basis, sure, some companies are going to do well and some are going to do badly, and it's our job to find the ones that are going to do well. And it's not to say you can't get decent returns if you're selective, but just to think all companies are going to do well, I think is wrong in the current environment. And the current environment, I think, is characterized by and has been, for several years, too much debt. There's a hang of a lot of debt out there, and debt tends to slow spending because the burden of repayments is high, and the willingness to lend willy-nilly is also not really there. And I don't see how debt or credit is going to grow fast, partly because the size of the pile is so large, it's hard to grow the pile. But also the aging population, as people get older, who wants to take out a loan when they retire, when they're not going to get the same level of income that they used to enjoy to pay back that loan? And why would you be taking out the loan? And why would the lender lend to you? I suppose, would you take out a loan to take a cruise? That's the ultimate bad loan, because there's nothing coming out of the cruise, obviously great experience and so forth, but there's no income producing purpose for that loan. So a bank shouldn't want to lend to you. They want to lend to you if you're going to buy a house because that house effectively is generating an income or a rent saving or something like that, that allows you to justify that purchase.
So Hugh, given all that, and once again, excuse me for old world analysis, after a recession and a downturn, we saw economies gradually getting better, and we saw interest rates starting to rise and inflation rise, and then we get a boom, and then we end up in another crash. But given the negative outlook, and I don't think all of your analysis is way off the mark, does this mean that we actually could end up in recession without even interest rates rising for a period?
I think so. What we've got at the moment is weakness in pockets in Australia because of the resource weakness. You are seeing Western Australia looks pretty poorly. The Perth, for example, they're building office blocks that will sit vacant once they're completed. They built already a lot of office space, and mining services companies are trying to sublet space because they've shrunk their head count. Anything exposed to the resources sector is weak. But in Australia, we've had a very strong East Coast where the housing boom has made the consumer relatively confident. We've had quite good consumer spending, and we obviously had a lot of housing construction. So we haven't gone into recession. But I don't actually see interest rates going up, and yet I don't rule out the possibility that we could slip into recession, particularly if the housing boom cools, and there are reasons to think that might happen. One, it's a very strong boom at present, and also there's a lot of foreign buying of new construction. So, if that foreign buying dries up because people lose interest in buying in Australia, or there's capital controls imposed in China because China's got a huge debt problem. I mean, that's getting into a whole nother area. But, the whole Chinese economic miracle is a little bit unsound in terms of how strong it is. It's really based on a huge overinvestment in property and infrastructure. Okay.
Now, Hugh, given all that, what 2 or 3 companies do you think has the ability to have growth and pay reasonable dividends? Because your scenario is saying don't expect term deposits to interest rates to rise, and so these poor old people who you described sitting at home doing nothing, they want some decent investable returns. So what kinds of companies do you think can weather the negative headwinds that you're talking about?
Well, look, one of the areas in Australia that has been extremely strong where we have good innovation and we have some world-beating companies, is healthcare. And there's several good companies in that segment, but unfortunately I find myself talking about it often because it is an outstanding company, and that is CSL, which has grown very rapidly over its entire listed history and continues to grow. They spend more than $500 million on R&D, which is funding or kind of underpinning a growth pipeline of new products and enhancements to current products and so forth. So, and I don't think it's extravagantly priced. So that's one example of a company that I think will grow. I'm quite favorably inclined towards Tattersalls, which is the lotteries operator in most of the states of Australia. Western Australia, it's a government-run thing, but I think the lotteries business is very defensive. It grows slowly but steadily, pays a very good yield, well above a term deposit. What other companies should spring to mind? I think last time I was on here, I mentioned Chorus, which is a New Zealand infrastructure provider. Very solid earnings based on building a broadband network in New Zealand in a private company form, unlike the NBN. Very modestly priced in terms of valuation, and I foresee quite a good dividend stream in the future.
Great stuff, mate. Well, thanks for the analysis, and even if people only half agree with you, there's some very good defensive plays to add to the more courageous ones that some people might want to have a go at. Thanks for joining us, Hugh.
You're welcome. Thanks, Peter.